All right, hello everybody, and welcome to this week's edition of Selfwealth Live with about 5 minutes of technical difficulty. So, apologies for that. Once again, we're only subject to the technology that we're using, so the software we're using, which is actually really good software, but sometimes doesn't go to plan as usual. Yeah, welcome everybody. Welcome everyone on the chat here. Thanks for coming once again. And Jason, welcome to you this week. How are you? How are you going?
Hey Rog, I'm good. Good to be back for another show. Looking forward to talking about some markets, looking at the view of stocks this week. I think it should be pretty interesting to go through it all.
Yeah, of course. What we are, as usual, what we're going to do is going to go through the Australian, the US, and the Hong Kong markets in general, the indices especially. All right, and then if there's any questions around technical analysis, that's what this show's about. Technical analysis, the way we know it, and the way Jason, our expert, knows it as well, because there's so many angles and avenues to go down, so many rabbit holes to go when it comes to technical analysis. So, but we'll do our best the way we know it, right? So. If there's any questions, pop them in the chat. And of course, the favorite part for everyone, I'm sure, is for us to analyze and have a look at your tickers from that technical analysis point of view as well. Let's get straight into the disclaimer without fail here, Jace.
So, of course, everything today, general commentary only, no personal advice in any of this. And I'll quickly put on the disclaimer, which just goes through all that. All general commentary, licensing is here. Also, I'm not part of Selfwealth. So my details for Motion Trader at the top. Beneath there, all the details for Selfwealth.
Fantastic. Thanks, Jason. Obviously, you can always find all these details. If you really love reading disclaimers, you can find them just down on the bottom. They are important. I don't want to make light of them. Obviously, they are very important, but you can find them at the bottom of these videos as well. All right. I love the comment from Max trying to. I'm telling you, Max, Macus, I'm going to have the best painting ever when I do have it. I've got it in mind, and and you wait to see what that painting is going to be. It's going to be amazing. So just stay tuned for that one. All right, let's get onto that Aussie market. It has come back up, obviously, and started to stall there a little bit. Let's have a look at that one there, Jace.
Yeah. Okay. So let's start with our chart of the ASX 200, and we spoke about the potential for a strong rebound when we did last week's show, and that's very much what we've had. We've had that nice snapback rally, and I just put on the indicator that we were looking at last week, which has helped with this, and this is showing the percentage either above or below the 50-day moving average. So the 50-day moving average is this red moving average on the top. I've got the 100-day below there, but we're referencing the 50-day for this. So you can see this midpoint line through here on the indicator. When the line's above there, that's above the moving average. When it's beneath there, it's below the moving average. So that's how this works. And so this indicator helped us identify the potential for a rally in mid-March. You can see when prices got quite stretched, got down to 6% below the moving average. That's when we started seeing that rally in mid-March. And what we can do, I can just run a string line across here. Let me just compress that. You can just draw this 6% region in. You can see where it touches here on other occasions, and it's been useful on the most recent bounce because we can also draw another line through here at 8%. So 8% is another reference point. You can see sometimes the market gets stretched 8% below the moving averages, and that's what happened on this occasion. We've got 8% below the moving averages, and that's where the rebound has come from. And there's no magic to this. It's simply a case of when a market gets stretched beyond its moving averages. Could be on the upside, or it could be on the downside. When it gets stretched, there's that tendency for prices to snap back towards the average. So that's what we've been seeing in the last week. This is quite an extreme stretch when it gets 8% below its 50-day moving average. We don't see it that often. So in the last 3 years, it's only happened twice. So it's a pretty infrequent event. So does all this mean that that there's now a lasting low in place? Well, I still think it's too early to say. if this happens to be a panic-driven event, then from what we've seen in the past, the worst is likely behind us, and it could still take several months for a lasting low to form, and last week's low could also be retested. So, for instance, look, there are several sort of examples we could use for this. So, this one here from 2018, I think we looked at this last week. It's where you get the initial decline, you get some rebound, but then there's still more work to do before the low's in. So here's some other sort of like extreme sell-offs where the markets come back to around 6%, and you can see like they're panic-driven events, not ongoing bear markets. The market quickly, within weeks or months, snaps back without a lasting decline. So I think based on what we've seen in the past, we could well and truly be seeing another sort of occurrence of those previous times now. What we don't know is whether or not the economic situation worsens, and that's also a possibility. And if the economic situation were to take a downturn in the months ahead, then when we look back at other past occasions where an economic downturn has followed a panic, that's when the rebound tends to be temporary, and when a longer decline starts to then take hold. And like an example of that was, let's just compress and quickly jump back to this period, 2007. So you can see we had the initial oversold and everything snapped back towards the moving averages. But this was the GFC. Then there was a larger economic downturn, which of course leads to a whole lot more trouble. That's probably a lower probability event, but that's why I say we just can't differentiate between the two at this relatively early stage. I think the odds favour that this has been a panic-driven decline, and that's because that's what most of these spikes in volatility have been in the past. Most don't turn into lasting bear markets, but as I say, we can't be sure. It only becomes clear in hindsight. And I think this is something really important to understand when you're looking at charts. The price action will never tell us what will happen. Nothing's going to do that. Nothing's going to give us that certainty to what's going to happen. So don't look at the charts for a prediction. I think people who think the charts are a crystal ball, I think they misunderstand their purpose. What the charts do, they help us understand possibilities, and then once we understand what could happen, we can then prepare accordingly. So am I ready to start buying with this oversold condition starting to reset? From an individual stock perspective, my answer is mostly no. As someone who follows trends, I don't really want to go out and start buying when a stock is trading below its moving averages. So a lot of stocks are below declining moving averages at the moment. So that's not when I want to start buying. I think that's a higher risk situation. So I'd rather miss buying the low and buying to strength later should prices continue to rebound. And this is individual stocks I'm talking about. I'm not doing a great deal at the moment. Much of my selling was at higher levels in recent weeks before we had that sharp move lower last week. I'm still holding stocks that are above their trailing stops. There's something we talk about each week, wide trailing stops, try and see your volatility. So far, quite a large portion of my portfolio has seen off the volatility, and I'm happy to keep holding those stocks. So this hasn't been a panic and sell everything moment, certainly not at this point. I think this is actually a time to act slowly. So act slowly and avoid panic in either direction. So I want to avoid panic selling. And I also I didn't last Monday when we had the panic selling, I didn't sell a single stock, and I also didn't buy a single stock when we had the panic buying on Wednesday. It's so that's why I say act slowly and avoid panic in either direction. You don't want FOMO, you don't want fear of missing out on the upside, and you don't want panic selling on the downside. As the situation starts to clear, I think there'll be plenty of time for larger positions later on. But at the moment, Rog, I think it's still a tread cautiously situation while we have this situation of declining moving averages and price below those moving averages.
Yeah, certainly, and I'm certainly thinking the same way. Obviously, being potential of further downside, but at the same time being ready with capital that's been made available from some of the stocks that have hit their stop losses during these down periods. But I think the point you make, though, once again, and if people are watching this, they will be challenged by people are watching this trying to catch lows. Trying to pick the low to get at a better entry point, because that's how, we've anyone in the stock market, I guess, when you're first starting off, you've kind of been trained that way to try and get something at the lowest price. That's just human nature, right? To get something cheaper than we can, than possible, right? But watching this now, hopefully, will challenge that idea to go, hey, we're looking to buy into strength and not potentially buying into weakness where there could be further weakness to come. So I love the point that you've just made there at the end, and hopefully people that are new to this concept will start opening up their minds to it as well, right? So all right, so let's get on to those US charts then. Let's have a look at those US charts.
Yeah, so going over to the S&P 500, and this has been a period for the record books. So the sell-off about a week ago on Thursday and Friday, not last week, but the week prior, that was the fifth largest two-day sell-off in the S&P 500 since 1950. So like, what's that, 75 years. The only periods with larger declines were during the COVID crash, the GFC, and the 1987 crash, which is probably outside the memory of a lot of the younger viewers. But yeah, people have been around for a while. They'll remember the '87 crash. But then on the back of that was Wednesday's rally, which was also extraordinary. That was a 9.5% rally. So that was the eighth strongest advance in over 100 years. So this really has been volatility on a scale that's it's rarely seen. We may only see this sort of volatility once every 20 years or so. It's like it just, yeah, that's why I say it's for the record books. I want to start by looking at what happened after some of these other big rallies. So I said that this was the eighth strongest advance, but what about the other ones? What about the other big strong advances, like ranking 1 down to 10? What do they look like? What happened during those periods? Because I think it's important to sort of like look at these periods and understand, like, is it a sign of money coming back into the market? And is it a sign of a lasting low? Because, of course, that's what a lot of people think when they see a strong rally. It's like, okay, it's on, we're going back to highs. So is that really the case? So of the rallies that were larger than Wednesday's rally, 6 of them were from the 1920s and 1930s. So they're valuable. It's always interesting to go back and look at them. But for the sake of today and compressing this a little bit, we don't have all day to go back through all past examples. I'm just going to focus on the 5 big rallies from more recent times rather than go back 100 years. So first up, first one I want to show you, it's not that long ago. It was during, actually there's 2 of them in this period. It was during the COVID sell-off, and there were 2 of them. One on the 13th of March, and that was a 9.3% rally. And a few days later, or about a week and a half later, on the 24th of March, there was another one, and that one was 9.4%. So the 9.4% rally on the 24th of March, that pretty much did mark the low. That was the low from the COVID decline. But look at the one that happened a week and a half early. There was still quite a bit of downside left. Time-wise, it was getting close, but price-wise, it wasn't there. Quickly jumping back to another period, and this was at the tail end of the GFC. There were we've got the 13th of October and the 24th of October. It was an 11.6 and a 10.8% rally. And let me just zoom in a little bit more. So there you can see that there's the rally. The rally. So at the time, if you're just looking at those, it's like, is that the low? These are strong rallies. Is that the low? But as as history will show, the low wasn't in for another few months, and at, of course, a lower level. And the last one, I just compress and zip back quickly. We'll go back, and I mentioned this earlier at the introduction, and it was 1987, the infamous 1987 crash, one of the strongest rallies ever, and prices surged, but yes, it marked the low, but it didn't mean stocks just roared higher week in, week out. There was a retest that occurred probably about 6 weeks later, a retest of the low. So it wasn't smooth sailing from then on by any stretch. So there we go. We've got like one quick low during COVID, one almost low but a bit more time, and then a couple of temporary lows during the GFC, and then it brings us to where we are now. With like, is this the final low? Like, where is this going to fit into that series we just had a look at? I think when we look back at those past examples, none of them tell us what's going to happen here. But I think it shows that a big rally doesn't necessarily mean that it's all over, and that's why I didn't rush to buy Wednesday's rally, because it's just not definitely telling us the lows in. It'll be interesting how that plays out. I want to show you an indicator whilst we're on the S&P 500, and this is showing the percentage. This is showing the percentage of S&P 500 stocks that are above their 100-day moving average. And so we were looking at, with the ASX 200, we were looking at another measure of trying to understand when a market has reached an extreme, when it might be oversold, by looking at the percentage below a 50-day moving average. This is looking at an oversold condition from another perspective. It's looking at the percentage of stocks below a 100-day moving average. And what's recently happened, you can see this blue horizontal line I've got marked in at 10. So that's 10%. So when the indicator gets down to 10, it's telling you only 10% of stocks are still above their 100-day moving average. So it's pretty much a washout. When you get only 10% of stocks or fewer above their 100-day moving average, it's we're in washout conditions where stocks have just been in significant decline, and this is where lasting lows are typically made. And we just compress this. We'll have a look. I won't put an overlay of the S&P 500 on, but I can just tell you these are notable lows when the market gets down to this point, and we can go back even further. You can do this sort of thing yourself with your own studies. But the thing with this sort of indicator, it's oversold can persist, as you can see on some of these occasions. It might get oversold, but then that condition can persist for a period of time before stocks start to rebound. Sometimes it happens quite quickly, but other times there's a bottoming process. You can see this period from during 2022. Prices started to rally, and then they came back and retest. So here we are now. So we've been down at 10%, and we've had a rally recently. It's currently at 27%. So I think with that rebound from oversold conditions, it's starting to shift the odds towards a larger rally. I'd like to see it sustain around this like 25 or above for at least a few days. It doesn't quickly come back and retest, but it does start to shift the odds that maybe there is a notable low or a notable low in or nearby. So this is something to keep an eye on. I think this is very much a case of just proceed with caution. So yes, the market's oversold, and well, it has been oversold, and it has rebounded as we've discussed, but it is still at what you'd call oversold levels. But conditions are just so volatile that I think the play here is to keep risk at lower levels rather than just trying to get it right within a few days of where a low might ultimately be. I know people want to buy the low, and maybe last week was it. Maybe that was the low, but I just don't think there's enough evidence to say that the low is in at this point, or rule out the possibility that prices do come back and retest lower levels, or even go lower. There's everything is still on the table. It's really a time to carefully manage risk and just not. I don't think it's a time for big, brave, and bold decision making. It's very much a headline-driven market, and it's a market that is below declining 1,500-day moving averages. So, Rog, I think this is a case of staying conservative rather than being bold.
All right, fantastic. Great view of historical patterns there as well, just to see what happened after those larger bullish moves. It's fantastic to have that perspective, Jace. Let's get onto this Hong Kong market then. Let's have a look.
Yeah, well, we're getting that rebound in Hong Kong, but with prices now below the moving averages and the moving averages rolling over. Also, lots of technical damage with such a swift and deep reversal, which has pretty much erased most of the gains from the January low. Of course, it has rebounded, but nonetheless, the sell-off did erase most of those gains. I just don't think there's a hurry to do a lot here just now. It's probably going to take time to repair the damage. I don't think there's a rush to be doing much in Hong Kong, and the same goes when we look at the Chinese market. Again, we've got that rebound, but the rebound comes right back to a couple of areas of potential resistance. So, one, we've got the moving averages, which are just above where prices currently are, and also you could draw there's probably some structural resistance coming in kind of around where prices are now, like all these previous low points kind of cluster at current price action. So you've got the structural overhead resistance coinciding with the moving averages. It doesn't appear to be a market that you'd want to be diving in and doing a whole lot with at the moment. I think the upside potential doesn't justify the risk at this point. I'd rather just stand to the side with the Chinese and Hong Kong markets at this point.
Yeah, and while we're here, why not have a look at Europe as well? Because a few weeks ago we were saying they weren't part of this sell-off, and now they are. So how are they looking?
Yeah, it's been an interesting thing. So Europe and Asia were slow to join the sell-off. So it was only so let's have a look at this. So the 21st of the 25th of March, the Euro Stoxx 50. So I'm looking at the Euro Stoxx 50, the largest 50 stocks in Europe. On the 25th of March, the Euro Stoxx was just below below an all-time high. And you go back over the S&P 500 on the 25th of March, and it was having a rebound to the moving averages after a considerable sell-off. So at that point, it wasn't a global sell-off. It was an S&P 500 Nasdaq-driven sell-off, or basically a US-centric sell-off with the ASX following suit. But we weren't seeing that across Asia and Europe. But that certainly changed when we had the basically free fall conditions in the previous week. And that's when the European market really broke down and started to catch up on the downside. Plenty of technical damage done again. It's we don't have a structure where I think you want to do a great deal. It's like, do you come in and just punt? These are the lows, as we went through with when we're talking about the ASX 200. It's like, is this like a panic-driven sell-off that stabilises? And those panic-driven sell-offs tend to stabilise within a few months, or does the economic situation change and then you start looking at the potential for larger declines? As I said earlier, we can't really say either way at the moment. So it's just a time for that cautious approach.
Okay, fantastic. We've got plenty of tickets to get through, but before we do, let's get on to this general question around time that you hold a stock. So from JG, Jason, question for you regarding stocks that are underperforming in the first 90 days of holding. An example. So we can start off with AUC. I bought AUC a while ago and it has been positive, but stuck in a range for a while. Meanwhile, other goldies doing really well. What are your thoughts in this case like this?
Yeah, I've got this stock myself, although I bought it in more recent times. I bought it just it was in late March. The position opened up, so I took a stake then. But the initial motion trader signal for this stock could have been back early to mid last year. Uh, at this point, this remains in an upward trend. It's not an established upward trend. It's still an emerging upward trend. I'm just getting a bit of history on it. So, like from the 2024 low, it does have that sequence of rising lows. So that's the building blocks of an upward trend. And we've generally got these rising moving averages, which price has mostly stayed above. So, for me, I'd be inclined to call this an emerging trend with potential upside from current levels. Whether it delivers like some of the other gold stocks, we don't know. And this is the thing when looking at gold stocks, I always say with gold stocks, diversify. I really want to diversify my exposure to gold because I've made this mistake in the past where I've concentrated on a narrow range of stocks and I've just been in the wrong stock. And I've seen others run, and then I've been stuck in the one that hasn't done much from previous. This is from previous gold cycles. So now I tend to try and get a broader selection of stocks that I have exposure to. So, and then if one doesn't really run hard, and others do, well, hopefully you're on some of the ones which have run hard. I'm holding this stock at the moment. I'm not looking at closing it out. I do use a 60 trading day time stop for my motion trader, my own personal motion trader portfolio. So if I'd bought this stock in October, I probably would have sold it some time ago, a few months ago, because it would have triggered the time stop. The time stop's not like a special magic indicator where as soon as 60 days pass, it means the stock can no longer perform well if it's below its entry point at that stage. It's just a way for me to move on from stocks which aren't currently performing and move into new opportunities. And sometimes these stocks can go track sideways for 6 months and then they fire up. And so the time stop doesn't mean that it's not going to work. It's as I say, it's just that process of being able to rotate capital into new stocks, new ideas quicker. Um, as I say at this point, though, I think this still has upside potential. It does look like it's been range bound. If it can break higher, the potential there for it to run. So I'd continue to give this the benefit of the doubt. Wide trailing stop below the 100-day moving average, below the April low, a break below the April low could probably trigger an exit event. But at this point, I think trends up.
Yeah, fair enough. And just to be clear, within that 60 days, Jason, the stock has to be at a loss for you to cut it, or can it be also in profit?
Yeah, the rule I use is if it's at a loss, it might be 1 cent. I might have bought it $1. It might be trading at 99 cents after 60 days. I'll go, okay, I just move on to the next one. So it's rules based, so it's not discretion based. And that's how I play it to keep it consistent. There's nothing wrong with adding a bit of discretion at some point, I guess. If a stock's in the red by 1 cent and it looks like it's stabilised, or maybe you could give it the benefit of the doubt. But I find it's a good way of being able to keep the portfolio active and keep exposure to stocks with upward momentum, maintaining that strong stock bias, as opposed to getting stuck in a stock where say it might trigger an entry signal. So I just make something up. Say there's a buy signal. Let's say the stock's broken higher, and we set a stop loss as such where the blue line is. And after 60 days, it's just trading sideways. It's not doing much. So I'd say, okay, I bought here, not doing much. I'm going to sell here, even though the stop loss is down here. And then over time, maybe it stabilizes and starts to go up. That's okay. Or maybe it continues to drift to the stop loss. But I'm just being more proactive and moving stocks on when they're not doing much after I've bought them. That's all it is. It's a more active way to manage risk. But there's absolutely nothing wrong with not using a time exit and just using a stop loss. That works too.
Okay, fantastic. Thanks for answering that. Let's start off with the top here. We've got some tickers to get through. So we've got one from Mike, and that is APA, please.
Yeah, well, this is a relatively strong stock. It's actually relative and absolute in its strength compared to the ASX 200 over the last month. It's above the moving averages. If I had this one, I'd continue holding it. I'd even consider buying it. I think this is a stock to consider buying. Look how well it's held up within that volatility we've had recently. It had been in a big downtrend. Now the structure shifted from below the moving averages to above the moving averages. And it just last week was trading at what would that be? It's like a 9-month high or something, perhaps. So, yeah, if I was to buy this one, I could buy it at current levels. I could have a stop below the 100-day moving average. What would that be? That would be, it could be done with like a 10% stop. So I think it's an asymmetric situation. Why is it being relatively strong? Why is it holding up while the market's selling off? Someone's supporting it for whatever reason may be, who knows what. Whether it continues to go up, we don't know. But this is a sort of situation which I would consider, as opposed to buying something which is in decline, hoping that it's going to stop and reverse course. Really interesting.
Okay, fantastic. The next one is IPX.
Yeah, this has all come apart quite a bit. It's for me. This is now. It's certainly not a buy. It's if I had it, I would have sold it earlier. As a like this was a motion trader stock. The initial signal was probably way back in 2023. Just looking at how it's progressed, would have been multiple buy opportunities along the way as it's broken out of these ranges which I've got on the chart. But if I had been riding this trend, or if I got on the trend late, it would have been an exit as it came back down below the 100-day moving average, broke below the January low. It probably would have been early March. Would have been hitting a wide trailing stop. I just want to be out of it. If I was stuck in it now, wondering what to do, it's like, well, the market's rebounding. It's not getting much of a bounce at this point. I'd have if I was holding this, I'd have to consider just maybe cutting it even at current levels. It's like I could have thought last week, well, look, if we get a strong rebound in the market, maybe I could sell this if it rebounds back to the moving averages. But the fact that it's not getting much of a bounce suggests maybe there's some sort of a stock overhang. There's supply coming in and muting the bounce. So I'd probably just want to be out of it. I don't know. Like sometimes these stocks, you get out of them, they recover, and you go, "Oh, I wish I hadn't sold." But the bigger issue for me, which I often talk about, is if I don't sell now, what am I going to do if it's down at $1? Then what am I going to say? It's like a bad situation can get a whole lot worse with individual stocks. So I'd just not want to have exposure to this stock at this point.
Okay, the next one is DR.
Just need to say, I'm not telling anyone what they should do. I'm just talking generally about how I see the chart. So everyone's got to make their own call on what's right for them. But for me, the fact from my eyes is I see a weak technical structure, and that's what I don't want exposure to.
course. All right. The next one is DRO, please.
Yeah, well, this is it's just looking interesting. We had the washout that we all know about from last year, and now we've flipped back to the positive side of the moving averages, and we've had that sell off in the market generally, which brought this back to the moving averages, and now it's rallying off the averages. I think there's a play here for those who are interested and are happy with a bit of extra risk. I think, like at current levels, to buy it at current levels, I think like it's a pretty it's hard from a risk perspective, given there is quite a bit of volatility in the stock. Like to have a stop below the 100-day moving average and have a stop below the April low. Like when I just look at this chart and I think if I was going to buy here, that's where I want to have my stop below the April low. Then when I measure it out, it's 38% away. So that's a pretty big sort of stop. And if you want to have a closer stop, well, you could easily just get clipped out if this just has some sideways trading above the moving average. It could easily come back 20% and clip you out. So I think that if someone's holding it, yeah, sure. It's I think there's upside potential, but the tricky part is managing the risk with it. I'd probably prefer if we got some sideways price action, and then if we did that, then I could say, okay, now we've got some sideways price action, the moving averages crept up. I can have a closer stop, or I can buy a potential breakout above some recent highs. I think this is an interesting setup, but I think it's a harder one to play just from that risk perspective at the moment.
Okay, fantastic. The next one from Mr. Vetpal, AWJ, please.
Well, we've had a nice trend, and that nice trend has moved into so. Is it still a consolidation, or have we had a structural shift? So we've gone from above the moving averages, prices now below the moving averages and consolidating. So that does add an element of vulnerability. Although I think this price action last week was interesting. Prices gapped down, traded below the March low, and then quickly traded back up, closing up near their highs. So that was a sign of buyers coming in to support the panic-driven sell-off. So there was a bit of panic. People jumped out. Others were happy to say, thanks very much, I'll take that, and they pushed the price higher. So that's I think that's encouraging price action. I don't want to buy it below the moving averages, but I think it could be a case that this could soon be back above the moving averages, in which case this is looking like a consolidation from the October high. I think a break below April's low spells trouble, and break at the April low, I think the whole thing could start to unwind. But we've had that high volatility event, and it's held up. So I'm looking at this with a positive bias. I think this could get itself back above the averages, and maybe we see some further upside. That's the way I'd be looking at this now. It's now just a case of like, when do you buy it? How do you buy it? It could be bought at current levels with a stop below the like if someone were to buy it now, might have a little bit of a punt. It's a 25%, say a 25% stop loss back below the that spike low. If that holds, great. It could be up and away. Alternatively, wait and see if there's a bit more strength, and then another pause above the moving averages, then another breakout. So it could be several weeks away, a possible trade. But yeah, definitely one to keep an eye on.
Okay, PLT, please. P for Paul.
Yeah, it's we had that nice breakout in January. It had been capped at around 78 cents for a bit over a year. Had the breakout, had the pullback to the breakout point. That's all textbook stuff. That's all fine. And then we had that breakdown. But the breakdown coincided with all that market volatility. Um, so I think if I think if I was holding this stock, it'd be depending on where I bought. If I bought the breakout, it's probably closing in on my time stop. How long that has that been? 53 bars. So it's probably if I had this, if I bought the breakout, I'd still be holding it. I would have used my initial wide stop, and that hasn't triggered, so I'm still holding it. But it's closing in on 60 days, so I'm close to exiting it. That said, if I wasn't using a time stop and just using a standard stop loss, I'd still hold it. I think it's encouraging that it did break below the breakdown point, but it's held, and now it looks like it's trying to get back above it, and then we can rationalise this sell-off as just being part of the general market panic as opposed to an individual stock specific issue. So, and particularly if I'm in from lower levels, I'd still be giving this the benefit of the doubt. I think the potential of this turning into a larger advance, I think it's still on the table. Although it does, I think we do want to see this low from earlier in the month hold. If that were to break, well, then we start getting a true false break, and then I'd want to be jumping out. But at the moment, yeah, we could still see this push higher.
Okay, one from Kelly here is APX.
Um, yeah, like this is a stock I wouldn't want exposure to. We spoke about, I can't remember which one it was. We spoke about it, something similar just recently where we had an uptrend. It's now broken down. It's triggered a wide trailing stop. If I had this, I'd be looking to. If I was stuck in this, I'd want to be not stuck in it. I'd want to get out. I don't want to hold and hope that it's going to come back, because for me the risk is that it continues to go lower. So um, my motion trader, I know this was a motion trader exit a few weeks ago, and yeah, I'd want to avoid happening for now. Certainly not a situation where I want to try and punt the low. I think it's too risky punting lows in individual stocks because, unlike the market, the ASX 200, which will almost certainly make new highs at some point in the future, we can't say that with any certainty whatsoever about individual stocks, especially stocks, small to mid cap stocks. There's so much risk when these situations unravel that the stock never comes back. So I don't know what this one will do, but I just know I don't want to get stuck in a stock hoping it's going to recover, because it's not like the ASX 200. Small to mid caps, they can stay in a bad position for a long time and sometimes don't come back.
And if you're in this position right now, Jace, what would you be trying to manage? How would you manage out of it at this point?
I'd sell it today. Um,
Yeah.
because like it's the market's rebounded strongly. We've had like a 10% up day or something in the ASX 200, and Appen hasn't really been able to play. The market's doing okay today, and Appen's trading on the slow, so it's got this muted bounce. My concern is that it's on its way to it's going to break below the April low. I think it's going lower. Um, Now, at some point, it could base, and we could look at this in 6 months' time, and it's back at $1.60, and people say, "Oh, look, you panicked, you sold at the low." It's like, well, so be it. I protected the capital, and when I do that, I do miss rebounds, but I also miss situations where a stock goes from 80 cents to 20 cents. So you think like, what would that be? I miss 50, 60%. Like if it falls to 30 cents, that's which is only here. It's not that far, really, when you look at the length of decline. That's 60% lower from current levels. That's what's untenable to me. I can't accept that risk. So if I can't accept that risk, I can't be in the stock. So I've got to get out now. And I miss the potential for a rebound. But if the rebound never comes, I'll be glad I bit the bullet and got out when I did.
Yeah, that's fair enough. And obviously, if you've got some other reason to be in it other than technical, you can always get back into it as usual. So, all right, next one along is a bit of a question with this one. So, Michael says, how would you approach the chart? So, let's have a look at CPU, please. CPU, where it initially gapped up, ran, and then slowly fell like the slide of a triangle to sometimes for some stocks below the initial gap up. So, yeah.
Yeah, it's hard. Like we know what the market's done in the last 2 weeks has been extraordinary volatility. So it's been caught up in that volatility, and nearly everything has been sold off. So had we not had that significant volatility, you'd probably find that it would have may well have held that gap, and it'd now be consolidating sideways along the moving averages, maybe preparing for another leg higher. So it's like this is very much broader market event driven. This selling we saw rather than an inherent weakness, I think, with the stock. If I had this, I'd be happy to continue holding it. I'd have my wide trailing stop, and it could take several months. See if over several months it stabilizes, and then from there can mount another challenge at the highs. So I wouldn't be particularly perturbed by the price action at the moment, particularly if I'm in from lower levels. If I've bought it on that breakout, well, it's like where do you have your stop loss? It's still feasible that it'd be a viable position, but then it depends. Do you use a time stop? Are you using how wide is your initial stop? But I think from an overall perspective, this uptrend hasn't been severed at this point. I'd give it the benefit of the doubt for now.
Okay, fantastic. The next one's from Kirby. Let's have a look at SLC.
So I've got this stock myself, and this is why we use a wide trailing stop, because it sees off these bouts of volatility. This stock's held up really well. It's a stock which has been in a big upward trending phase. Yes, it's a motion trader stock. That's why I'm holding it, and it's still above the motion trader trailing stop, which is, I'm not sure where it is offhand, but it's at least below these lows from March and February. Looks like it's trying to break out to a new high. So this is for me. This is very much a hold. I guess it could also be considered as I'm not in a hurry to do a lot of buying it at this point, but the trends in place and this at this point appears to be a consolidation. Say a break above the February high, I think would then look at that as being a breakout. So that would probably be then a buyable breakout, and then you'd have the typical stop loss below the 100-day moving average, and see where it goes. But very much for me, it's a hold. Let's see whether what this trend can do. It's withstood an incredibly volatile environment, so I think that's a good thing. Let's see what it can do if the market stabilizes.
Okay, great. The next one is TLX. Thank you.
It's I think it'd still be. Let's see how far that decline's been. I don't know whether this has hit the motion trader trailing stop or not. It'd probably be close. It could well have triggered the stop. Like a lot of stocks have hit stop losses in the last week. So this one is now borderline. It has been a great trend. With this, I'd be dictated where the motion trader trailing stop is. So it's a calculated volatility-based stop. If it's above there, great. I'm happy to keep holding. If it's triggered it, I'd be getting out. We don't have we're on the verge of a structural change. So if the price were to start to pull back, and then consolidate sideways, we kind of then get ourselves on the wrong side of the moving averages. Not quite there yet. Like, it's been a strong rebound back to above the 100-day, just below the 50. So it's a bit inconclusive there. Not a stock, definitely not a stock to be buying at this point. It's just a matter of whether I continue holding it, and that's where I say I'd be guided by the calculated trailing stop. And I think this is borderline. I don't know whether it's nicked the stop or whether it's just held above it. So. I think a break below the April low would be a real sign that the trend is over and we're now into a lengthier pullback. Watch that low, and also if you're a motion trader member, just look where the calculated stop is. I think that's the mark to use, and that's the advantage of having a calculation for your stop loss rather than just trying to do it manually by going, oh look, it feels right about here. It's a lot harder to be consistent when you don't have a calculation for your exit point, and it can become more emotional. You can give things more room than you should, or sometimes you give it less room than you should. So I think having the calculation really helps in these situations. But it's been a great trend, but it's really like, it looks like it could be coming to an end.
Okay. The next one is Life 360 from Hassan.
And this was I remember this one. This was a motion trader exit last week during the panic. I'm not sure exactly what level, but this had been a terrific trend. It had held in within this uptrend and gone up several 100% from its initial entry back in I think mid 2023. So that's almost a 2-year trend. Let's say an 18-month trend, few 100%, couple 100% or so. But now with this sell-off in the market, it had been trading sideways along longest rising moving averages, but then it has broken down. It's triggered a trailing stop. For me, it's an out. It could stabilise and go back higher, but it's like, this is the thing with having a trailing stop. It provides you with an exit point so that you're not going, okay, well, I'll see if it stabilises, and you end up, like, the problem I think for a lot of people is that they get these initial pullbacks and they hold and go, okay, it might be getting better now. It seems to be improving. Then it starts to roll again, but then they don't do anything, and then the thing keeps rolling, and all of a sudden it's given back 2 years of gains. So I think having that definitive exit point is helpful. I don't want to buy back into this yet. Its moving averages are pointing lower, prices below the averages. There's vulnerability to it. My preference would be, if I had it, I would have moved it on. If not last week, I'd be using this rebound as an opportunity to move it on at a better level. It's not to say it can't go higher in the future, but we don't have a crystal ball. We're managing risk, not trying to guess which stocks will go higher, which stocks will go lower. Trying to be clinical about it and saying, okay, no longer meets the rules of staying in, so I'll hop out.
Yep, fair enough. Next one's from Jacques, FID.
Yeah, again, a motion trader stock. This one is holding above, I believe this one is just above its trailing stop, I think, at the moment. But now it's on the wrong side of the moving averages. It's starting to consolidate. It's like a lot of these small to mid-cap stocks have had sharp moves lower generally. If it can stabilise here and get back above the moving averages, that would be good. But we don't know. Don't know whether that's going to happen. I don't want to buy it, but if I was holding it, particularly if I was in from good levels, I could give this one a little bit more time, particularly if it's above the trailing stop. But again, if the trailing stop's triggered, I'd be getting out. There's not, like, I don't have favourites with stocks. It's not like, okay, this stock has hit its stop loss or come back to its trailing stop, but it's a favourite. It's done really well for me. I want to keep holding this one anyway. It's like, I don't care. I've sold some, like a couple of stocks. I've sold 3 stocks in the last 3 weeks, which have been terrific for me. SKS Tech, TUS, TUA, and what was the other one? Gentrack. I've had multi 100% gains in all three, but they came back to exit point. So it was like, okay, thanks for the great ride, but see you later. It's not like, okay, I'm just going to stick with this one because it's been so good, because I don't want to see something that's been so good turn into something which is so disappointing because I didn't take action when I should have and let it go. So calculated exit point, try and keep it unemotional, don't get attached to stocks, and if they trigger exits, they go. If they bounce back, well, that's fine. It's not the ones that bounce back that cause the problem. It's the ones that continue to unravel after you should have exit that cause the most damage to portfolios.
All right. Next one on his list is PPS.
Yeah, I had this one and I sold it a little while ago. I sold it back in, I think it was early March. It was a time stop. So I must have bought it maybe in November when it was starting to break higher. And initially I was thinking, this is looking pretty good. Price structure was good. It had this big bearish phase. It looked like it was starting to get some nice momentum to it, and then it all just started to come unstuck in March, probably with the broader market volatility. So it was a sell for me when time stock triggered. Price action still continued to deteriorate. It stuck below the moving averages. I'd check on the motion trader trailing stop. If I was in at lower levels, I'm not sure whether or not it's triggered. But if it had, I'd certainly be getting out. If the motion trader stops triggered, I'd be using this rebound as a better entry point. In this type of environment that we're in, I'd use that rebound and go, that was a nice bonus. It'll need to stabilise, get back above the averages before I potentially get interested in it again. The structure does seem to have shifted. It's spent quite a bit of time now below declining moving averages, so I think that increases it reduces its appeal and probably increases its vulnerability.
Okay. All right. The next one along the lines is from Max is AFG. Declining highs and declining lows, please.
Well, this is really range bound. It's stuck in a range. It looked like it might have been starting to break out in February. So you can see the contracting price action. And in February, like you can't get an exact line; they don't match up completely. But just for the sake of showing the contracting lower lows, we've got rising highs and lower lows. We've got a contracting price action. We've got a breakout. That's often a good signal. That's often a lot of times when you see that sort of structure, like you end up like with the basing structure that breaks higher, it often leads to a good outcome. But not every time. Not every setup will play out and give a big reward. It's fallen back within its range. For me, it's lost its appeal at the moment just because this for me. This is neutral. This is a neutral stock. It tried to break lower, couldn't break lower, it snapped back. So it's like, which way is it going to break first? Is it going to? I think whichever way this breaks first is where the next trend comes. Does it break the February high or does it break the April low? Whichever goes first, I think that's where the momentum starts to move. So for now, I think this is a good one to continue watching. We just don't have a trend. These these lengthy periods of price compression where the ranges where the price action really just sort of like clumps together and compresses up, they often lead to strong trending periods when prices break one direction or the other. A break to the upside could lead to a really nice trend in this stock. But I think we've got to wait for that breakout to occur one way or the other rather than preempt.
All right. QUB is the next one.
It's a bit of a theme with a few of the stocks. We've seen nice trends, which have been severed by excessive volatility. This would be a motion trader stock, which is still above its trailing stop. I was just measuring how far it's come back 17%. So the wide trailing stop will give it that much room to move around. So for me, this would be a hold, particularly if I'm in it at good levels where it first would have been triggering a signal. And there's going to be some support coming in. You can see from these previous highs, it's going to be a support region. And that's also sort of coincided where it gapped lower and then traded back up. So it is below the moving averages, but I do like how it opened low and then closes high on that day of considerable panic last week. So I'd be giving this, if this was in my portfolio, I'd give this one the benefit of the doubt if I was in the good levels. And but if it were to break below the April low, it's probably a sign that then the structure has shifted from being above moving averages to being below. Like this is a case of sell the rally. Is the structure shifting from buy the dip to sell the rally? It's like I'd give it the benefit of the doubt now because the trailing stop is still intact, but it needs to get itself back above the moving averages. So until we can really say that sell cycle has been disengaged, and it's either going to go sideways and consolidate maybe for several months before possibly breaking higher later in the year. So benefit of the doubt for now, but yeah, we want to see it back on the good side of the averages, not spend too much more time below.
All right, next one is MLX, please.
Yeah, so I'm in this one myself, and this has been disappointing because it had this great gap higher, and now it's starting to really come back. So is this due to market volatility or is it stock specific? In the end, it won't matter if it hits its exit point. I'll get out of it regardless. I won't say, oh, it's just coming back because the market's volatile. I don't think I want to do that because what if the situation continues to deteriorate? I don't want to get stuck in something which keeps declining. At the moment, it's above its wide trailing stop, but it probably doesn't have a great deal more room to move around. It's such a sharp pullback. I would have liked had it come back and started to find some sort of support on the way down, as some of the stocks we've looked at today have. This one hasn't. This one just keeps the selling just keeps pushing it lower. So it's on. Yeah, I think this one's on the brink of an exit. Not there yet. Certainly not buying it, but it's on the concern list.
Okay. We got one from James, which is OBM. Is this the sort of dip Jason likes to see?
Well, at the moment, it's just like really a day of volatility. Can't tell too much from that. So tomorrow could trade back up, and it's just like one bar. So it's not really a dip at the moment. It's just like one bar. It's a gold stock. It's going, of course, it's going to be highly influenced by what the gold price does. The gold price is extended above its 50-day moving average. We've got the US dollar crashing. We say crashing might be a little bit extreme, but we've got the US dollar selling off quite aggressively. Anything can happen in this gold space at the moment. Gold could accelerate higher, but it's in that stretch above the 50-day moving average where it can also like top out. So I'm holding all my gold stocks. I'm not doing a whole lot of buying in the sector at the moment. It's more a case of holding what I've got. I've got some of this one, so I'm holding this one. I'm not too keen to buy the dip just because of where the gold price itself is being extended. But I'm happy to hold. I'm happy to hold this one and see what happens. Let's see where this gold rally goes. It's great for people who've already got some positions. I think it's a harder proposition for those who are now looking at gold, going, gold's been going pretty well. Should I get some exposure? I feel that the time to have gotten gold exposure was earlier. Now is probably not the time I'd want to be initiating my first exposure to gold.
Okay. All right. The next one here, actually, I haven't heard this one for a while, is BUB. Bub.
It's just not doing anything. Yeah, I just don't think there's anything to see here. It's not. It's just going sideways. There's not a downtrend. It's not. There's a gentle downward slope maybe to the trend, but there's not much in it. Uh, I think it's just to leave alone. It need to break above the February high. Well, then maybe we say, look, there's some emerging momentum coming to it. Maybe we start to get a sequence of rising lows, but we don't have that at the moment. This is just one to avoid. And if I had tried to buy an earlier sort of breakout, my time exit would have got me out of this one long ago when it was just started meandering. And if it were to probably break below the April low, it would probably be a sign of more maybe lower levels. So yeah, just for me, off to the side for the time being.
All right. Next one is ILUKB. ILUKB. Maybe that's not the one. I'm not sure what it could be.
ILUKB. I've got to see.
LLUKB. Maybe it looks like an I, but LLUKB.
UK. Okay, well, if you don't have an ILUKB, that's why I got the C in there before. So I don't know. ILUKB. Nothing coming up under that code.
Let's go back to that, Caroline. If you want to just pop us and give us the name of that, and that might be bit more clarity. Let's get on to EBR, please.
EBR. Unless it's something related to ILUKA, which is ILU.
It could be, yeah.
Well, yeah. ILUKA's like strong downtrend. I wouldn't be in it. I would have been out long ago when price started breaking down. It's like it looks like a Star Entertainment, ILUKA. In that got this persistent downtrend, people trying to pick the lows all the way down, the thing deteriorates. This is a sort like we talked about this with stocks like APX. This is a situation I don't want to be in where say a stock peaks and starts coming back and falls heavily. I'm sort of stuck going, oh, I should have sold earlier, but I haven't. Do I want to bite the bullet? But I'm worried if I bite the bullet now, the thing's going to rebound and I'm going to be disappointed. What I'm more disappointed in if I hold on and the stock continues to unwind. For me, that's more disappointing than missing a rebound. This is what I can't have. So it's just a little bit more to what we discussed earlier. But yes, next stock, Rog.
EMR. EBR. Sorry, EBR.
Yeah, I'd give it I think I'd give it the benefit of the doubt. Look, I'd have to look at where the motion traded trailing stop is. It's a volatile stock, so it's possible it's stayed above its trailing stop, but it could have also hit it. You can say that the uptrend hasn't, from a moving average and price action perspective, the upward trend hasn't been severed at this point. We've seen considerable volatility, enough volatility to potentially to trigger a trailing stop. But if someone hadn't been stopped out on this sharp move lower, it's possible the stock could stabilise at somewhere around current levels and push higher again. We don't have that structural shift where the price is now clearly below declining moving averages. It's right around where the moving averages are at the moment. So if I was in this, if it hadn't hit my trailing stop, I'd give it the benefit of the doubt. But I think this low from last week probably really needs to hold. Otherwise, it does start to get into a bit of a sell cycle. It's not there yet, but it's probably, we probably want to see some more price action, slightly towards the benefit of the doubt, see if it can stabilise at current levels. But we don't want to see this low from last week break.
Okay. The next one along is EMV.
Probably, let me just see how far back it's come. I think this look, it's an example of how a nice structure doesn't always play out. So had we been looking at this last year, I would say this is a really nice structure. It's stepping high. It's gone from below to above the moving averages, sideways into the averages, rally again, sideways, rally again. I would have been quite excited about this, saying, yeah, this is a stock I'd be happy to have in my portfolio, and I'd be giving it room to move and hang on. But this is the thing. Good setups don't always lead to big trends. And when they don't work out, we have a plan to get out and go and put our capital elsewhere. Uh, I'd need to check where the motion trader stop loss is. I don't remember whether this one's triggered or not. Some of them are quite wide because this is has been a volatile stock, so it's possible that it's still holding above it. In which case, if I got in early on, maybe I would keep holding. But if I'd bought a later break, it would have been below my time stop, and I would have been out. I think this stock really needs to hold the line around these lows from February and April. I think a break below those lows, then we start saying, yeah, we've now got declining moving averages. The stock's making new lows. The path of least resistance is now lower. I'd want to be out. Any hope of being able to say, look, there's support around this sort of region. For that to happen, I think it's got to hold those lows. Otherwise, I think the risk is that it starts to unravel. In terms of making this stock look get some encouraging price action, it's got to take out the March high, get back above the moving averages, take out a recent high. So yeah, it's one I'd be pretty much neutral on at the moment, but then whether it's a sell or not would depend on whether your stop's been hit now or whether it's got a little bit more room.
All right. ADT.
I think this is all just a bit of a mess at the moment. It had that large decline in July, rebounded but didn't make a new high. Then it's now quickly pulled back again. Like I don't think this is a stock I'd be. Then again, I guess we could say that it was looking like it was breaking above the November highs in March. How far has the pullback been? Look, I think this would be, look, at best, I think this is just sideways mess at the moment. We don't have a dominant trend really, which is really in place. It's not trending down. It's not trending up. It's just making a volatile sideways trek at the moment. So I'd probably prefer to be out of this stock just for now. If it were to break above the March high or the May high from last year, then maybe that's a sign that momentum's coming back in. But it's just not there at the moment. It's just at the moment we're just kind of sitting in the stock, which just doesn't really have that momentum to it. So I'd probably rather have that money on the sidelines and in a volatile environment.
All right, fantastic. Neil wants us to look at NAG. Sorry.
Was that NAB?
NAG.
It's like a 2-cent stock. It's the chart structure here is of interest. A long downtrending period, strong rally back above the averages, just pull back and trading along the averages. Someone really likes this stock for some reason. Like, it's a really buy on trust sort of situation because, like, you buy at current levels, where do you put your stop? You say, look, I put my stop below these previous lows. But you're kind of looking at a 42% stop loss. It's a tough ask to do that. If all your stops are going to be at 42%, it's going to be a difficult situation, I think, to manage over time. But yeah. And like if you buy a breakout, but then you've got the same problem, where do you put your stop? So I guess if someone really, really likes it and is happy with a 40% hit, like now could be the time to consider it, because if it spikes higher up to 3 cents, well then we're going to be looking at like probably an even bigger stop. I don't know, maybe buying into strength is a better play, because it could just keep meandering sideways. Roger, I'm pretty neutral on this. I don't have a strong view. I can see this. I kind of like the structure where it's rallied. It's gone sideways. It could be getting ready for another rally, but these low sense stocks are just too hard to manage from a risk perspective a lot of the time. So I'd probably just have to leave it alone.
All right, fantastic. Macquarie Bank, please.
What's Macquarie's code?
Is it MFG? Macquarie Financial Group, something along those lines.
Just look that up. Macquarie Group, MQG.
MQG, that's the one. Yeah, MQG.
Yeah, no, this is a stock I wouldn't want to be in. It's too big the sell-off's too big. Yeah, so that sell-off's going to take my trailing stop out. It's below declining moving averages. The potential for a bit of a rebound is certainly there, but it's the structure's not right. It's below declining moving averages. So I'd and we've seen this before. We've seen these big sell-offs before in Macquarie. I think from the perspective I look at a stock, from a medium-term perspective, I don't want to be holding stocks in this situation. That said, if someone's a buy and hold investor, they're probably not watching this show. So I think from a medium-term trend following perspective, it's not a place I'd want to be at the moment.
Yeah, fair enough. We'll finish off on DXB then, Jace, Matt.
Yeah, I'm looking at it from the perspective of is this a large consolidation period, like with the nice upward trending phase, and so I don't think this is a consolidation anyone would have sat through. It's been too big a pullback. But in terms of is it going to regain momentum, it was looking like I wouldn't come in and buy this stock at the moment. But the underlying structure was looking fairly encouraging back in a few weeks ago, back in mid March. For me, this really needs to get back above the averages and stabilise and start to break higher again. It's not a stock I'd be in now. If I'd bought in with that breakout in January, I think this pullback would have been enough to say, look, I've probably just got to close this risk down, and it is below the moving averages at the moment. So it's probably not where I'd want to be just now. But this whole period from the last 18 months could turn into a big sideways range at some point. We do see higher levels. But I'd probably say, look, I'm just neutral on this one at the moment. We don't have a structure I want to be involved with, so I'd probably just leave this one alone.
Okay. All right. Fantastic. I think we are done for the day. I'm pretty sure I've gone through everyone. There's a few comments in there around the work you're doing, Jason. So thank you very much for that. Lovely to have everyone on board once again for another week. Don't forget to like and subscribe on this channel or this video so you can get all the updates. And obviously if you want to try out Jason's service over at Motion Trader, you can just check the link down below for the Motion Trader service. And if you want to check out Selfwealth, there's a link below for that as well. If you've got any questions, you can always just shoot an email to me or attention it to me, and it'll get to me at support@selfwealth.com.au. Other than that, have a fantastic Easter, everybody. Easter break. Hopefully everyone has the full time off. right. Well, if you've got more time off, fantastic. But we will be back next week on the Tuesday after Easter as well. So looking forward to that, and hopefully things will looking better by then. But let's just see what happens. Don't forget, do your own research. This is general advice only, and make sure you stay safe out there. Thanks a lot, Jace.
Hey, thanks, Rog. Thanks everyone for joining in. Hopefully it's been interesting, and yeah, look forward to next week.
All right, till next week. Have a good time.